Hey everyone, it's Wrenchin' AI here, and let's talk about building long-term wealth. Today we're diving deep into Infosys. One of India's biggest tech giants, kind of like their version of Microsoft or Google. We're talking 30-year investment horizon, people. Should you buy and hold, or is this thing gonna crash and burn? We're gonna break it all down, the good, the bad, and the ugly. Stick around because this is the kind of analysis that can make or break your portfolio. Oh, and before we get started, remember, I'm not your financial advisor. This is for educational purposes only. Do your own research, talk to a professional, and make informed decisions. All right, let's talk Infosys. This isn't some fly-by-night startup. We're talking about a company that's been around for decades, a titan in the Indian tech space. They're right up there with the biggest players, TCS, Wipro, HCL Tech. These guys are the real deal, and what are they killing it in? Cloud computing, AI, cybersecurity, all the stuff that's blowing up right now. This isn't some outdated tech company. Infosys is on the cutting edge, and that's a good sign for anyone looking long-term. Think about it, 30 years ago, did you even know what the internet was? Now look at it. The point is, tech changes fast, and Infosys is adapting. They're heavily invested in the future of tech, and that's where you want to be if you're playing the long game. Remember, we're talking about potentially life-changing wealth here. You don't get that by investing in yesterday's news. You get it by spotting the trends early, and Infosys is right in the sweet spot. Now let's talk about reach. Infosys isn't just some big fish in a small pond. They're operating in over 50 countries, working with Fortune 500 companies, the biggest players in the world. That tells you something right there. When these massive corporations need tech solutions, they're calling Infosys. And it's not just about who they're working with, it's about the sheer scale of their operation. We're talking about a global workforce, a massive talent pool, and a reach that most companies can only dream of. This isn't some small-time operation, this is a global powerhouse. And that global presence translates into one thing: revenue. Infosys has a track record of consistent revenue growth, and that's not an accident. It's the result of strategic expansion, smart acquisitions, and a deep understanding of the global marketplace. Okay, let's talk about putting money in your pocket. Infosys isn't just about growth potential, they're also about rewarding their investors right now. We're talking about consistent dividend payments year after year. This isn't some speculative bet on the future. This is about getting a piece of the profits today, and that's huge for long-term investors. Why? Because those dividends, especially when reinvested, compound over time. Think about it, 30 years of dividend payments reinvested year after year. That's how you build real wealth, slowly and steadily. And it's not just about dividends. Infosys also buys back its own shares. What does that mean for you? It means your ownership stake in the company increases, and so does your potential for profit. They're literally putting their money where their mouth is, investing in their own success, and that's a good sign for anyone along for the ride. Now let's get real for a second. Investing isn't just about rainbows and unicorns. You need to look at the cold, hard numbers. And when it comes to Infosys, the numbers look pretty darn good. We're talking about a company with strong financials, a healthy cash flow, and minimal debt. This isn't some company drowning in loans, struggling to stay afloat. Infosys is financially sound, and that's crucial for long-term stability. Think about it, 30 years is a long time. You're gonna see economic booms, recessions, maybe even another pandemic. Who knows what the future holds? But with a company like Infosys, you've got a better chance of weathering the storm. They're not going to crumble at the first sign of trouble. They've got the financial strength to adapt, to pivot, to make tough decisions when they need to. All right, let's talk about the future. The world is going digital, right? Cloud computing, AI, automation, this stuff isn't going away. In fact, it's only going to get bigger. And who's perfectly positioned to capitalize on that trend? You guessed it, Infosys. They're already heavily invested in AI. They're developing cutting-edge solutions, and they're attracting top talent in the field. This isn't just about keeping up with the times, it's about being ahead of the curve. Infosys is betting big on the future of tech, and that's a bet I'm willing to take. Think about it, 30 years from now, AI could be as ubiquitous as smartphones are today. And the companies that invested early, the companies that saw the potential, those are the companies that are going to reap the rewards. Now let's be real, not every investment is a smooth ride. Markets go up, markets go down, that's just the nature of the beast. But here's the thing about the IT sector, it's not like some other industries that are super cyclical. We're not talking about energy or real estate where prices fluctuate wildly. The IT sector is driven by long-term contracts, recurring revenue streams. Companies need these services year in and year out, and that gives Infosys a certain level of resilience. They're not immune to economic downturns, but they're better positioned than most to weather the storm. Think about it. During the last recession, when other companies were struggling to survive, Infosys was still profitable. They still paid their dividends. They still invested in their future. Okay, let's talk about the elephant in the room: competition. The tech world is a jungle, and Infosys isn't the only predator out there. They're going up against global giants like Accenture, IBM, Cognizant. And let's not forget about their Indian rivals, TCS, Wipro, HCL Tech. These are all hungry players, all vying for the same piece of the pie. And as the IT sector gets more crowded, as more companies enter the fray, it's going to get harder and harder to stand out. Infosys can't afford to rest on their laurels. They need to keep innovating, keep pushing the boundaries, keep finding ways to differentiate themselves. They need to stay ahead of the curve, because the moment they fall behind, the competition will be there to eat their lunch. Now let's talk about geography. Infosys is a global company, but they're heavily reliant on the US market. Over 60% of their revenue comes from the US and Europe. Now that's not necessarily a bad thing. The US economy is still the largest in the world, and it's likely to stay that way for the foreseeable future, but it does create a certain level of dependence. What happens if there's an economic slowdown in the US? What happens if there are changes to visa regulations that make it harder for Indian companies to operate in the US? These are all factors that could potentially impact Infosys's bottom line. They need to diversify their revenue streams, reduce their reliance on any single market, and be prepared for whatever the future holds. Let's talk about currency risk. Infosys earns most of its revenue in US dollars, but it reports its earnings in Indian rupees. So, what happens if the US dollar weakens against the Indian rupee? It means Infosys's profits, when converted back into rupees, are going to be lower. That's just the nature of doing business internationally. And it's not just about currency fluctuations, global recessions, economic downturns. These can all impact IT spending. When companies are tightening their belts, they're often the first to cut back on IT budgets. That's just the reality of the situation. Infosys needs to be prepared for these cyclical downturns, manage their expenses carefully, and have a plan in place to weather the storm. Here's the thing about the tech world, it's constantly evolving. What's cutting edge today could be obsolete tomorrow. And one of the biggest disruptions on the horizon is automation and AI. Now, on the one hand, Infosys is a leader in AI. They're investing heavily in this technology, and they're well positioned to benefit from its growth. But on the other hand, AI could also disrupt their traditional IT services business. Think about it, if AI can automate many of the tasks that Infosys currently performs for its clients, what does that mean for their future? They need to be prepared for this disruption, embrace the potential of AI, and find new ways to add value to their clients. They need to be the disruptors, not the disrupted. Let's talk about the stock market. It's a roller coaster, it goes up, it goes down, and sometimes it feels like it's just going sideways. And IT stocks, especially high-growth tech stocks like Infosys, can be particularly volatile. They can experience sharp corrections, sudden drops in price that can be nerve-wracking for investors. But here's the thing, if you're investing for the long term, 30 years in this case, short-term fluctuations shouldn't matter as much. In fact, market dips can create buying opportunities. The key is to not panic, to stick to your investment plan, and to remember that time is on your side. The stock market is a marathon, not a sprint. So, is Infosys a good 30-year investment? It's not a simple yes or no. They've got a lot going for them. Strong fundamentals, consistent growth, a healthy balance sheet. But there are also risks, competition, global uncertainty, the ever-changing tech landscape. Here's the bottom line, if you're looking for a get-rich-quick scheme, Infosys is not it. But if you're a long-term investor, if you believe in the future of technology, if you're willing to ride out the ups and downs of the market, Infosys could be a rewarding addition to your portfolio. Just remember, diversification is key. Don't put all your eggs in one basket. As always, I'm Renchanai, and I'm here to help you make smart financial decisions. If you found this video helpful, hit that like button, subscribe to the channel, and let me know what you want to see next.